as measured by real inflation rather than CPI. If, as I suspect will occur, we begin to see retail buying from North America and Western Europe on top of Chinese retail buying and foreign central bank buying, then I think you'll see a real move in the gold price. I'm surprised that silver has followed on as quickly as it has in this market. My experience has been that silver lags gold for a substantial period of time and moves after.
Let's talk about gold with Rick Rule. Retail buying has been low, but U.S. gold shops are buying more from customers. Gold ETFs are mostly seeing outflows, except for recent days. Foreign central banks have been the main buyers due to concerns about the U.S. dollar. But if retail buying picks up in North America and Europe, along with China, we could see big changes in gold prices. And get this, gold's market share is tiny compared to other investments. If demand returns to normal, it could quadruple. So, stay tuned for some potentially big moves in the gold market.
Frankly, as you'll note from past interviews, a little surprised that the breakout didn't occur earlier. When people would ask me with impatience around the gold price, when is gold going to move? I used to say, well, I think it's going to move beginning about 2000, which is when it did move. In 2000, the price was what, $250? Now it's 24 and change. Gold has done precisely what it's supposed to do. It increased 8.6, 8.7, 8.8% compounded for 24 years. It's just that wasn't enough for most people because most people had silly expectations. The set of circumstances that should cause gold to move have certainly accelerated over the last 2 or 3 years. There's a couple interesting things to note about the gold price that have escaped most popular attention that people need to pay attention to. First of all, there's been no retail buying. You notice retail buying because you're a bullion dealer. But the truth is that there has been disintermediation. There's been selling. Gold shops, retail gold shops in the United States have been much more active on the buy side, which is to say buying gold for melt from their customers than they have been on the sell side. And gold ETFs have been experiencing outflows, except for the last 11 days in the United States, for a very long time. The buyers of gold have been foreign central banks, concerned about the politicization of the U.S. dollar, and also concerned about the deterioration of the purchasing power of the U.S. dollar, as measured by real inflation rather than CPI. If, as I suspect will occur, we begin to see retail buying from North America and Western Europe on top of Chinese retail buying and foreign central bank buying, then I think you'll see a real move in the gold price. When will this occur? I don't know. I just think it's more probable than to occur than not. And I'd like to bring up one more thing, but people listening to this show might not have listened to earlier shows. The market share of gold and precious metals related assets is stupidly small. The market share in the U.S. of gold and precious metals related assets generally is less than 0.5% of all the savings and investment products in the U.S. market. The 2-decade mean is 2%. If precious metals related assets return to mean, demand for them quadruples, which is precisely what I think is going to happen. On a global basis, no similar measurements exist, but it is estimated that the value of gold and gold equities worldwide is less than 1% of the value of publicly traded equities on the planet. I don't know what the median is with regards to that, but suffice it to say, gold doesn't need to win the war against the U.S. dollar. Gold just needs to lose less badly. If gold returns to the 4-decade mean, demand quadruples. And that's precisely what I think is going to happen. I'm surprised that silver has followed on as quickly as it has in this market. My experience has been that silver lags gold for a substantial period of time and moves after the precious metals narrative has attracted generalist investors to the space. It would appear that the breakout in gold occurred 2 or 3 weeks before the breakout in silver began to occur. In my experience, this has normally taken 18 months. So I'm a little out of my depth in terms of explaining why. I actually don't know why. I had talked on earlier episodes of your show about the fact that the asset class with the most upside volatility in precious metals was silver equities. And I had expected that after a breakout in physical gold, that a move in silver equities would take as much as 2 years to occur. It might be that things in the world are moving much more fast than they used to move. I don't know why this is true. I just note that it is true. Well, certainly the charts of the real gold equities are performing fairly well now. They're catching bids. While at the same time they're catching bids, they aren't moving up to the extent that one would expect them to, given the strength of the underlying commodity. There's a whole bunch of things to say here. The first thing to say is that gold mining as an industry has been a pathetic performer, not in the stock market necessarily, but in a corporate sense for a very long time. So investor expectations around gold stocks are pathetic, deservedly pathetic. If you invest in the gold mining sector, even today, there's a probability as opposed to a possibility that you will lose money if you invest in the whole sector. What you need to know about gold stocks is it's all about stock selection. In a gold stock universe as broad as the XAU, say 40 issuers, there are probably 5 or 6 or 7 that are superior performers as companies and therefore merit consideration as investors. In a real gold bull market, of course, the good, the bad, and the ugly will all do well in the market. But exposing yourself to the bad and the ugly exposes you to too much risk. And if you come down the quality trail into the juniors, which is where the speculators like to inhabit, the probability of success is smaller, but the reward for success is higher. There, it's all about securities analysis. Truly all about securities analysis. And it's about a phenomenon that you and I have talked about many times called Pareto's Law. In the juniors, it's all about the people. There are a group of people who have been serially successful. And then there is the rest, what Mencken referred to as the great unwashed. And the great unwashed are lethal. Those promoters who succeeded perhaps as car salesmen, used car salesmen, but otherwise have track records virtually unblemished by success. Compared to them, of course, you have Ross Beatty, 14 companies, all 10-baggers. The whole game in the juniors is to associate yourself with serially successful people, first of all, and associate yourself with companies that, given the extraordinary risks that they're taking on, are engaged in activities with the potential for extraordinary rewards.
Thanks for tuning in to today's discussion on gold with Rick Rule. Don't forget to hit the like button and subscribe for more valuable insights on investment opportunities. If you have any questions or thoughts, feel free to drop them in the comments below. Until next time, happy investing. Thanks again.